Now, as we pivot into the international world, we want to look at what is happening with Iran. So the U.S. sent its comments to Europe, which has then turned them over to the Iranian delegates. And again, it's a game of cat and mouse in terms of what is going to happen. We do think something gets done with the European Union. We think the U.S. blesses it, but doesn't go in on it as well, keeping some sanctions, which is going to become just as convoluted as it was prior to 2015. But I think that you will see Iranian barrels in Europe before year end, and that will help alleviate some of those problems, which is what, again, the market, the market is competing with, because you have CPC coming down, you have Libya now back, but unknown. You have Iran potentially coming in. Russia is obviously not coming into the into Europe. So that's where you keep having these different shifts in the market. All the while, Chinese demand continues to diminish. And now they're increasing exports, which is why we're having that new shift or that new surge of diesel into the European and U.S. markets, or I should just say into the Atlantic Basin, which continues to be the case. So China's imports of crude from Angola fell to 2.13 million tons in July from 2.35 million tons in June. And just to be clear, it's the lowest for any month since July of 2011. So again, China is just not buying the same amount. So even though you're getting the supply coming down from CPC now, Iran could come back, may not come back. We're still in that, but the Chinese pressure is the one that keeps things, fairly capped. One of the things here is, and now for those that know me, because I wasn't doing this during 2016. I was very close to what actually came to market from Iran, and I was above forecasts, but now. And I say that just because when we look at the forecast going forward, there's some assumption that it's going to be similar, and it's not. And the reason why is because in the past, they relied on Russia filtering some of the European and U.S. equipment into Iran. They relied on Russia a significant amount, but that has now gone away, given now there's much stricter sanctions on Russia because of Ukraine. So they don't have the capacity to do that, and that's going to limit. And then China hasn't cared about the sanctions. They've been buying Iranian crude outright. So there's also a certain amount of, how much can actually new supply come back? How much of it's just going to get reflagged from Iraq to Iran? And that's what's going to minimize the new crude coming to the market, which we think we could see a bump of about 350,000, but they're only about 150 to 200,000 that would be quote unquote new. Some of it just reflagged. And the biggest issue and we're going to talk about this more as we go forward, it's just shipping costs have gone up. And it's because there's just more miles per ton, more ships that are now being sailed, because what used to maybe take 10 days is now taking 20 or 30. So in the past, what you could do with one ship, you now have to do with 2.5 ships. And that's where we're seeing this. And just the distance itself is going up. So that's more money per day, which is increasing the freight rates because you're sailing longer, so you have to pay for it. And then just the absorbing some of that spare capacity is also creating another increase in underlying rates. India imports went up. India crude oil imports rose 35.4% year on year to 20.3 million tons, the highest since April. Again, taking advantage as much as humanly possible with Russia. Not a surprise there at all. Imports of LPG, still strong. Fuel oil diminished. Diesel, it increased, but they're typically net exporters. So that was why when we talked about the different shifts on the different components, that they put a price cap and then they dropped it, and I should say they put a big tariff. They then lowered it. So, and this is why. Then when you look at exports here, you can see exports were down slightly for diesel. You can see that it was down 3.3% year over year, but gasoline went up a sizable number. That's something that we expect is going to continue. But you can see that diesel is usually their net exporters. So the fact that they imported, that's why the percent change is so large. Don't be panicked by that. Gasoline consumption was up 6.8% year on year. Diesel consumption was up 8.2%. Naphtha was down 6.1%. LPG was up 1.7%. So again, and LPG was the highest since March. So you're still seeing a significant amount of LPG. So even though local U.S. demand has come down a bit, Chinese demand has fallen. You're getting some of those cuts out of Europe on the petchem side. India and some other places in the Middle East still remain strong. So again, you're still seeing some of this pull through. Again, it's just going to stay very elevated from the U.S. because we still remain price competitive. Then when you start looking at the Middle East, this is what we need to consider when looking at what Saudi Arabia is saying. Middle East crude oil floating storage is above 2017 levels. It's still below 2016, that blue line, but you see, you're just getting an idea. It is still at a near record level. So when you hear Saudi Arabia saying that they're talking about cutting production, this is why. Because when you think about September, you have the end of summer burn. You have OSPs that are grossly mispriced versus where the market is right now. And you have floating storage, coming in and getting close to testing 2016 levels. So you can either reduce your price or reduce your new production and try to get some of this to go at an elevated level, which is something that we've continued to see here. Now, we also said last week that we had Urals trading a bit tighter. Instead of -30, it's -19. And some of that is just because the evolution of the market. Northwest Europe has been able to move some things about, resale. And then you have that big increase in shipping, which again also eats into some of those numbers. But you're also seeing some of those pivots. But again, the Middle East is the biggest concern. And here's another reason why. So right now, Brent, when we think about dated Brent, it's trading 560 above Brent, above Dubai. So now if we think about where, and I'll just pull up the numbers real quick. So if you consider the price in general, Saudi Arabia is, and this is talking Asia Superlight, is $12.15 above Oman Dubai. So you have dated Brent 560 above and Saudi Arabia $12 above. So again, even if you're paying through the nose on shipping and insurance, it's expensive to buy Saudi Arabian crude. Extra light is $10.95 above. Light is $9.80 above. So really anything that you're looking at, they are mispriced in comparison to Brent and how that is moving, which is resulting in a lot of this crude also being stuck in the water. Now, with the elevated amount of floating storage, the distance, crude oil on the water is now at a new record. It is now crossed above where we were in 2020. And this is, again, the biggest concern that we've talked about. We're now at a new high for 2022, and we will remain there because you do have China trying to buy as much, taking advantage of where they can. There are issues getting it onshore that's leaving it in the water, so floating storage remains elevated. You have the misprice out of Middle East, putting more crude in the water, in floating storage, and Russia's still shipping a fairly decent amount, and it takes longer to get there. So when you break it down to its pieces, crude oil in transit breaks to a new high, close to the highest it's been in 2022, and it will likely be above that at this point as we go forward because you're starting to see a little bit of an increase in what China's purchasing, more along seasonal lines, still well below, but moving in that direction. All the while, floating storage remains above 2021 levels, and we just believe it's going to stay either just above, just below, but right in line with where we were in 2021. It's just when you think about 2020, floating storage remained elevated, but crude oil in transit crashed. So there was that backdrop where now you're going to get elevated floating storage and more floating crude oil in transit, which again is going to keep things well above normal. Asian floating storage trending back up based on what their purchases are, and the slowdowns internally, we expect this to continue to move higher and actually go back to where we were in 2021. Now, when you look at Shandong teapots, you can see that they continue to fall on the operational front. It's now down to about 62%, 61% utilization rates. It'll likely stay here at this point unless they can export more. China's overseas shipment of gasoline and diesel rose. Gasoline shipments rose to 880,000 tons, about 21% more than a month earlier, and the highest since April. And that's equivalent to about 237,000 barrels a day. Exports of diesel increased 9% month on month. And again, as we were saying, now they did get bigger quotas, so there were already bigger quotas for the export market, but they're going to have to continue to get new quotas because China's refiners were given the additional quotas to trim stockpiles. However, allocations are still significantly lower than last year, and they're going to have to see those start to increase. Otherwise, you're going to get some of those slowdowns. China's commercial stockpiles of gasoline and diesel fell over the past 3 weeks. But again, because they've been able to export and runs continue to be low as they're trying to, again, manage some of this activity, you're still seeing state plants are still trying to export, and they still remain very, very out of normal because demand for diesel and gasoline are increasing, but still well off of the peaks that we've seen in the past at this time around. Traders, so typically there's a bit of a restock for consumption in September and October. That should increase just because of the lockdowns. But when you look at, there's still so much in storage, and you still have refiners running at very low rates. So you're going to see more crude left in the water and a bit more product being exported into the market, which has freed up more of that diesel to flow into the European and U.S. markets. West Africa floating storage moving back up. Again, you're just seeing the pressure here. It's just a matter of where can they find the right price. When we look at the different OSPs, so when we start going back through the different backdrops, you have Okoro at $10.85 above. You have Oyo at $12 above. So dated Brent. And again, it's just whatever has the highest distillate cut is going to continue. But you still have China buying. They're now buying Angolan crude at 2011 levels. So yes, even though there's demand and you've had, again, West Africa not producing at the same level, you're not getting any real pickup. You're actually getting less and less purchasing from Asia. So a lot of that is being replaced by Russia. But again, so even though you're still running well below OPEC levels, there's over compliance, there's still not enough demand because of Asia. And that's, again, resulting in more and more left on the water. So then here you can see crude oil, China's super tankers has turned back up, still on the low end, but it's just going to be a matter of what prices are they getting? Are they competitive? Otherwise, they're just going to be, taking whatever they can at different points, trying to maximize price. Then when you look at product exports, gasoline exported, they increased 18,000 barrels a day, up 225,000. Distillate had a nice pop of 271,000. Some of that is a little bit of a makeup. So again, we'll talk about that in a moment. Where propane was up 581,000 barrels to 1.7. Again, 746,000 above the 5-year, still strong. Crude oil exports dropped 823,000, just back to 4.1. Again, still elevated, not quite at 4.1, but still, and a lot of support to stay at 3.7, 3.8. Gasoline exports right at the top of the cloud. We expected it to come back within the cloud, but stay at the very top end. So again, we expect to bounce at that elevated level as Pad 3 tries to manage flows. Some of this will continue to go down into the Latin American markets. Distillate, we were expecting it to stay, right at the 5-year average. Instead, we got a big spike. Based on what we're looking at now and based on the restrictions coming into Pad 1, instead of, if you remember, we thought it was going to come to the 5-year and maybe just below. But based on some of these shifts that we're seeing, it'll likely now, we're going to change this and say it'll stay above the 5-year average. Not so much at the top end of the cloud, but at an elevated level as they try to manage some of this flow because they can't get it into pad 1. So they'll try to do it in a more roundabout way, which is, again, and try to capture that healthy market as cracks remain very strong. Ethane exports still remaining elevated. We expect them to remain, again, at that high. Then when you look at crude oil exports coming down a bit, but as we said, the 4-week rolling average, much better. And it sits at that 3.7, which is where we think we're going to live just based on the demand going into both Europe as well as into Asia. Then when you look at propane, propylene, again, new all-time highs for 2022. It's going to stay strong. It's going to stay in that all-time high level, upper end of the cloud, and again, still remaining robust. We did get some draws out of Fujairah, and this is, again, some of that pivot going into Europe, or I should say west of Suez when looking at this component. So total products were at 21.787, a drop of 1.983. Light distillate fell 181,000 barrels, still at above 8 million at 8.4. The East of Suez gasoline complex strengthened a bit on some lower supplies from Taiwan and some higher demand from Pakistan. But remember, Pakistan had canceled some tenders. Now they're coming back into the market. So it's just going to be a matter of how much of that actually comes through. And the greater gasoline import demand is due to expectations that the IMF will provide Pakistan with a $1.18 billion loan. So that's why, again, they canceled the tenders. Now they're back. We still see a lot of pressure on east of Suez and west of Suez when considering light. Middle distillate fell 120,000 barrels to 2.808. The East of Suez gas oil complex found some support. And the reason why is because higher flows to the west of Suez, coupled with was all really driving East of Suez strength, because you're getting some of that flip. Again, a lot of this is going to continue, and the strength in the East of Suez market will be driven by, again, the strength in the West of Suez market. Refinery turnarounds and higher seasonal demand in the West could lead to, again, more support in the East of Suez gas oil complex, which we think is very likely. Heavy resid fell 1.682 million, down to 10.557, falling to their lowest level since mid-June. Trading activity on bunker was tepid, but again, with the uptick in oil prices, people were trying to lock in. So this is more of an arb than it is about real demand. So we don't see too much in terms of that coming through. So we do expect to see builds in light distillate, builds in heavy, but again, middle distillate remaining robust. The Brent time spread at 87 cents, just showing that things are cooling off when you're just, again, looking at the rate of the pace of the rally. And that's why we think that we just hang out at this point at these levels, because, again, that time spread has cooled off there. Nigeria's October exports of Kyobo crude are set to fall to the lowest levels since last December, while loadings of Agbami will climb to the highest in 7 months. And again, there's a lot of that back and forth. ExxonMobil offered Angola's Dahlia crude for October loading at a weaker price in terms, instead of it being at 50 cents below dated Brent, it was 55 cents. You're seeing some additional cuts in Fortes and some of the others, and that's where you hear Saudi Arabia saying that the paper market and the physical market have disconnected, but then you're looking at the physical market issuing some additional price cuts. So again, it's just a matter of talking your book versus trying to clear out some of that very elevated now floating storage. Russian Federation, you can see, is at 1.357, and the CPC falls under that Russian Federation piece, so that will remain reduced. Angola, you've had some deferrals, you've had some of that. Same with Nigeria. Not a lot of strength coming out of West Africa, as we see China buying at levels not seen since 2011. So we're at 10-year lows, just to give you an idea of where China's buying. Libya continuing to hang out at about that, just over 1 million. So everything else is fairly firm. So not too much to see in terms of changes. And we will see more Russian crude come to market based on what can go through, especially on the ESPO side. When you look at crude in Europe, continued to fall back down to the lows. There's a mixture of Rhine River issues as well as just run cuts. So there's just not as much demand for new imports, which is going to keep these tanks running near the lower end. If we start to see natural gas prices come down, which is unlikely in the near term, then you'll start to see a bit of a pickup. But again, we're not seeing too much movement one way. So we're going to stay at the low ends on the crude side. When we look at refined products in Europe, there was a build across the board, but obviously we have to put it into context. Gas oil, small build, but you can see we're still at record lows. That's, again, keeping that gas oil, that distillate moving into their markets, which is why the west of Suez is remaining so strong. And so much of that of that distillate is coming from the Middle East, from Asia, into the Atlantic Basin. Gasoline back to the highs. We're right at where we were in 2020. Again, this is going to just support more exports as they try to manage this, because there's just so much gasoline in their market, and they're going to try to push this out. And then when you look at fuel oil continuing to trend up, we're right at where we were in 2020, 2021. And this will get pushed into east of Suez. And this is something that we expect to show up in Central Asia, just because refinery run rates are cut or slowing. They typically recrack this. So now they're going to try to, again, get it off the shelf and move it into the international markets. Singapore, build of about 1 million, driven by resid and a small middle distillate. Light disti had a drop of that 1 million, but we expect that to snap right back. As we were saying, total stockpiles right at the average. We don't see it going too far up or below because of the back and forth. So even with a drop in light distillate, we're still at all-time highs, seasonally adjusted all-time highs, still near the highs of 2022. And just, we don't see that changing just in terms of demand on the east of Suez side, and just the amount of gasoline that's in the European markets, which is going to keep us at the higher end, especially as refiners try to make as much distillate, you inherently throw off that gasoline. In middle distillate, again at the lows, small build, but it doesn't matter. We're still at a very low level. And then when we turn over to resid, it's dropped, but starting to build back up. We expect it to just creep back to that kind of that 17 or so year average, not too much one way or the other. And it'll go back up as I think Europe dumps more fuel oil. That'll put more resid back into storage. So again, it's just going to be that shift back and forth. North Sea floating storage back to zero. It's whatever can be, maybe imported. They've been trying to sell some. So this is going to remain at the low end in terms of what can come through. As the Rhine got back, some bottlenecks on the Rhine rose a bit. So some of that was able to move through, which allowed some of this to normalize a touch. And then European floating storage came down, still a bit elevated, but again, as that Rhine levels normalized. So as this comes down, we should see some builds, but still at the lower end, just because we're not getting a whole lot of activity out of European refiners. So that's what we have for you today. If you have any questions, you can find us in the comments section, or obviously find us on Twitter. And as always, we appreciate your support. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.